Today on the interview with me, Ayesha Faridi, I have Vincent Nichols, investment specialist for US equities and global thematics at BNP Paribas Asset Management. He works very closely with global investors to decode the structural forces shaping US markets, from policy and geopolitics to innovation and small cap opportunities. Vincent, thank you so much for your time today. First trip to India, how does it feel?
Great so far.
Yeah.
Yes, first trip. It's very exciting. I've been to Asia many times, but nothing quite like this. I love the food. It's an exciting culture and an exciting city. Can't wait to be back.
Right. You know, when you talk to investors, I have to first talk about what they're saying about the US. There's a lot of concern about Mag 7 and how those 7 names are actually holding the markets up. But first, let's talk about the broader view. I mean, do you think the markets, now that they're at record highs once again, is this rally still supported by fundamentals, or do you think the valuations are kind of running ahead of themselves?
There's a lot of layers to that question. Yes, some indices are at record highs. Many are. If you look across the spectrum of U.S. equities, you see small caps just reaching new record highs after 4 years of being below the 2021 previous high. However, the large cap indices have been making new highs continuously for some time now. It has been fundamentally justified. A lot of the momentum year after year, quarter after quarter has been driven by superior earnings growth, revenue growth, margin expansion. That is all continuing, but to your point, and I think the crux of your question, you are seeing valuations in some places getting a bit extended. There is the possibility that earnings continue to grow into those multiples, but there's also the possibility that you could get a pause, a slowdown, and a shift to other parts of the market that start to deliver fundamentals that have been underappreciated.
So let's take it one by one. Where do you think the earnings pause is coming next?
The earnings pause?
Yeah.
That's a tough question. I'm not sure in terms of valuation and the weakness that could happen from the overvaluation, if that is the case, I don't think you're necessarily going to see an earnings pause. I think you're more likely to see just a lack of momentum and maybe a lack of optimism justifying further multiple expansion. You might see at some point in the next 3 years a digestion period for CapEx and AI investment. Even if there was just a pause in the amount of CapEx, it's at really, really high levels already. So you may not even have growth there, but still there could be an enormous amount continued to be allocated there. And if there is a pause there, then there could be a pause in earnings growth.
So is tech that space where you think that it's nearing that overvaluation pocket?
In some cases, but there's still plenty of opportunity there. There's also, without naming specific names, some companies that you think, it's a very overly optimistic view on where that earnings growth could go. Generally speaking, I think tech valuations are higher than average. But what you also see with tech in general is you see much higher margins than we had a decade ago. You have much higher return on equity than we had a decade ago. And this has really diverged from the rest of the global economy and the global stock market. So in some senses, a higher multiple is justified for the foreseeable future as long as these fundamental drivers hold up.
Sure. But the point that you were making, Nicholas, what about the CapEx piece? How do you think that's going to tie into earnings, and then how the market values some of these tech companies?
The CapEx, I think, is likely to continue. And the companies that have been leading the CapEx are extremely profitable, have enormous cash flow, and they're primarily funding this CapEx via cash flow. Some of these companies are raising capital and raising debt more recently, but not to an alarming degree. But overarching theme is these companies are financing this CapEx via cash flow. And I think the commonality between all of this investment is it's existential. and then they have communicated accordingly that to stay competitive as a leading technology firm going forward, you need to invest in AI, you need to invest in accelerated computing resources, and it's something that must happen, and it's less of an ROI in business decision than an existential risk.
So when you talk about the entire US tech base, who do you think is going to win the battle? And I want to also talk about, where does sort of China come in over here? Because for now, it seems that US is heading the IP and the product race, whereas it could be about all of that available at a cheaper price when it comes to China. And then, of course, you have some of the other Asian-dominated sectors, which are also sort of leading the race when it comes to hardware or the entire supply chain.
Yeah. So far, the tech companies that are winning the race in terms of profitability are without a doubt in the U.S. In terms of actual technology development, I think everybody was taken a little off guard earlier this year with developments in DeepSeek. There's no doubt that China is seeing enormous gains in terms of technological development. We have yet to see anywhere close to the fundamental profitability coming from that technological development from those companies. But you also see much more attractive valuations there, just on a per earnings basis. So, there could be some catch-up trade there. But I think for the very near future, you're likely to see continued at least strength or resilience at a minimum from some of the large cap tech in the U.S.
Yeah, and that was my point. I mean, if someone has to invest in the U.S. in today's day and age, will they have to have exposure and a large exposure in their portfolio to AI and tech?
Not necessarily. So we also do a lot in U.S. small caps. There's several unique differences and complementary characteristics of small caps versus large caps. Certainly, there's AI infrastructure and there's AI technology permeating down to the small cap level, but not nearly to the extent you see in large caps. And you see a lot more exposure to cyclical industries like financials, industrials. You have a lot more exposure to healthcare, which has been under pressure for the last few years. And even the makeup of the healthcare segment of small companies versus large companies are very different in terms of characteristics, growth profile, maturity, and unlike large cap and how we're talking about the valuation concerns there, you don't have that with the small caps. They're trading right around their long-term average versus their own history, and compared to large caps trading at a significant discount. This alone does not necessarily mean that they're going to outperform over the next 6 months, but over the longer period, it's a pretty good indicator for how they will perform relative to large caps over the long term. But we see potential catalysts in a resumption of earnings growth there. We're already starting to see those green shoots in the most recent quarters, and expectations are on the rise for future earnings growth as well.
So in the near term, though, where do you think the alpha generation opportunity is when you come to U.S. equity markets? And would you say that small caps is it?
I think it's a good place to be, and it's certainly a good complement. I would not advocate to investors to abandon what's been working for so long, especially given the fundamental profile. I think it's unlikely that you see fundamentals deteriorate for large cap tech. But there's a broad appreciation for what's been driving that move higher. And small caps, which have seen earnings significantly below previous peaks, have seen enormous headwinds from the higher for longer interest rate backdrop. Now we're starting to see that shift into a tailwind as rate cuts are well underway and continuing significantly into next year. So I think that could be a very complementary piece to a portfolio that has a key position in large cap U.S. equity to gain alpha from a similar economy, but just touching it a little bit differently.
Sure. But Vincent, if I were to talk about a leadership shift, and I don't know if it's going to happen, because what it seems to be the case right now is that it's a very broad-based move that you're seeing in U.S. equities. But if there were to be a leadership shift, would it come at the cost of large cap underperformance, or at least ease off? Maybe underperformance is a very strong word that I'm using. And then do U.S. small caps catch up? Or do you think it'll continue to be how it is right now, more of the same, wherein you will have that broad-based move and small caps and large caps will all do good?
If there's a leadership shift, yeah, then certainly you're going to see the dynamic of relative performance change. And certainly that could come to the benefit of small cap versus large. And it doesn't have to be in an up market. It could happen in a down market. We saw that in the dot-com era where when the correction happened in large caps, small caps actually outperformed in a recessionary environment, which is highly unusual. That could happen again, but even more probable, in my view, is you continue to have move upward, but you have significant earnings growth in the smaller companies and a potential catch-up trade and even some outperformance in the short term. But it's hard to make that call in terms of the timing or, if the fundamentals continue to be strong on the large cap side, it's going to be tough to outpace those names. So it's hard to make that call with lots of conviction. And so I think having those two complementary pieces is a good approach.
So you don't see the tech sector and the Fab 7 in particular ease off anytime soon, do you?
Not necessarily. It's hard to say with a lot of conviction, just because the fundamentals are so strong. And really the arguments against that trade continuing is it's getting a little bit rich, it's getting a little overextended, but the fundamentals that is driving that shift, those have not deteriorated whatsoever. The CapEx is not slowing. The CapEx intentions moving forward continue to be better than expectations every single quarter. So there's a lot of reasons it could continue, especially in the short term. What happens 2 to 3 years from now, I think that's more of a question mark than maybe the next 6 months.
So what will happen 2 to 3 years from now?
Yeah. That's a great question. I do think there's going to be a digestion period for the CapEx spending, only because the law of large numbers at a minimum will make it difficult to see significant growth in CapEx when you're spending several hundred millions of dollars on AI CapEx year after year. For that to grow at a high rate going forward, it's just not economically feasible. So at some point you'll get that digestion period, and then you could get that multiple contraction, but it doesn't necessarily mean that you see earnings go negative or a major slowdown. It could just be a more subtle leadership shift.
Sure. But would that result into stock consolidation / digestion, as you call it? Or is it going to mean also some sort of massive correction that these stocks could see?
It could be either, and I guess it depends upon that pace of CapEx could be a big factor impacting that. If it's just a slowing of growth, right, I think you're unlikely to see a major correction. If you see an outright downturn in CapEx and a huge pullback on those intentions for whatever reason, right, that's going to have a very different impact on the market and could be something more dramatic.
Interesting. What other than the U.S. tech right now is looking priced to perfection? What's looking like it still has a certain headroom, and what's looking like it's undervalued?
Yeah, so it's interesting. There's other pockets of the U.S. market that are looking pretty rich and pretty concerning in terms of the momentum that's taken hold, and not necessarily just large cap tech. Within the small cap universe, which we invest in, we're starting to see pockets of euphoria over optimistic speculation in companies that are very early in their development, and they're already growing into multiples beyond the small cap space with very little fundamental justification and just a positive narrative in the long term. That's creating some underperformance for high-quality investors in the small-cap space, but that could reverse quickly, and that's something we're cautious about moving forward, and are a little bit concerned with that level of over-optimism. But unlike large caps, it doesn't constitute a significant.
When you make this premise and thesis for investment when it comes to US, I guess a lot of it also has to be factored in about the current US government shutdown, what's going to come about of tariffs, what's going to be the impact of that on the overall world economy, not just the US. And then, of course, what role does Fed play? So walk me through what is your assumption on all these three scenarios?
Yeah. In terms of the macro backdrop, in terms of the policy backdrop, as you correctly note, this is going to be material to the investment landscape moving forward. I think less so in big cap tech. I think all of the things we've talked about up until this point in that regard are going to be more impactful than the policy backdrop. In terms of small caps, which are more cyclically oriented, more tied to the domestic economy, there's a lot of moving pieces that are going to be influenced by policy. You have the big beautiful bill, the ability to depreciate CapEx in the first year. That's going to create a lot of incentive for companies to start building and investing in their future in the domestic economy. You have more protectionist policies, which could create some margin compression for companies that have relied heavily on external production. But at the same time, you could see a sharp increase in industrial activity, manufacturing activity, which have all been in contraction for at least a short cycle. But in the case of industrial production, there's been stagnation for really 25 years in the U.S. And there's a big push by the new administration to reinvigorate the domestic economy, reinvigorate industrial production. And this is likely to have a strong impact, I think, broadly speaking, on the more cyclical parts of the market, i.e. small caps, industrials, et cetera.
But this will be a long cycle. I'm sure the markets will factor in much ahead of time, as they always do. But what about the fears of a recession because of the impact of the tariffs, and purely because it's going to be a long gestation before which the U.S. can become very sort of inclusive and will have all the capabilities and manufacture all that it consumes? Yeah,
you're completely right. So the upside that I'm laying out in terms of the policy backdrop, it will take time to take hold. The downside, right, margin compression for certain companies, that's going to happen in the near term and is going to create headwinds. We've seen labor activity stall in the U.S. It's not looking outright weak yet, but it's certainly not as strong as it was a year ago. So there are some concerns about the direction of the economy, and some of that is influenced by the policy backdrop. I think it's important to keep in perspective, though, how rare it is for recessions to happen in the U.S. It's approximately once a decade, and a little bit less frequent than even that. So you can have a modest slowdown without having a recession, and then still have some resumption of economic activity without too much economic impact or fundamental impact on markets. And that's a much more likely scenario. An outright recession is very rare, could happen, and all of these confluence of factors could lead to that. But I think it's a low probability outcome, and I don't think people quite appreciate how low a probability that is.
That's a very interesting take. But this has also been the longest running bull market, hasn't it? And the steepest climb that we've seen since COVID, which was 5 years back, by the way, since we're talking decades.
Yeah, I mean, so the bull market post-GFC was the longest bull market in history, briefly interrupted during COVID, and then you had this enormous stimulus coming out, in response to COVID, and that resulted in an immediate exit of the bear market. So we're not actually that far along in the current bear market. And even in between COVID and now, you had 2022 when interest rates went up at the fastest pace in 40 years. We had a pretty significant drawdown in high growth stocks then too. So the market rally, while it's been quite strong and we've seen some multiple expansion, particularly in the large cap, it's actually not long in tooth. So it could continue for some time.
So when you, as an investor, look at the U.S., do you really talk about all the factors, geopolitics being one such case in point, and the kind of friction because of the tariff tirade by your administration with regards to many other countries, and specifically, of course, China and Russia and the positioning thereof? Is that a factor at all when you make investment calls basis U.S. stocks?
Absolutely. Right. You have to factor in the macro backdrop. It's more heavily influencing the way we speak to clients about the asset allocation into the products we're selling. What we do very well on our investment team is bottom-up stock selection, finding ideas that are undervalued, underappreciated, versus the stocks that are peer to those companies, and being able to outperform a broader index by just finding better ideas in each pocket of the indices that you operate to generate the outperformance and try and mitigate some of the other top-down risks. Because all of the things we're talking about, they're very tough to call, they're very tough to time. We feel a lot more confident in our ability to find companies that are doing the right thing, underappreciated, growing above expectations. We feel more conviction in being able to do that than to make a call on what's the macro future and how does the landscape shift in the near term as a result of that.
So if someone were to make a fresh allocation into U.S. equities right now for, say, the next 5 years and next 10 years, that's a decade, what's the safest space to be in? Set of stocks, market capitalization, all of it?
The safest thing to do, I think, would be some diversification and some balance. We've talked a lot about the fundamental strength of the large cap space, but we've also talked about how some valuations have gotten a bit extended. But then we have this other attractive opportunity in down cap in the small and mid cap space, where we're just seeing an inflection point in terms of earnings, in terms of headwinds becoming tailwinds. So I think that's a necessary complement if you want a safe exposure to U.S. equities, where you get a confluence of factors, right? You have the continued power and strength of the large cap growth, but you also have this shifting dynamic in the smaller space where you have a lot more valuation safety.
But passive investing, which is index investing or stock specific?
We would, of course, advocate for stock specific, and certainly down cap, that's easier to do. The indices that people manage against in the small cap universe, they're very spread out. There's very little concentration in the top 10 or the top holdings of the index, which allows for a lot more expression of views in different parts of the market, and not a reliance or a necessity to be heavily invested in the biggest names and having that as a placeholder. So you have a lot more flexibility to express views in different parts of the market more dynamically. And historically, you've seen managers in the small cap space more consistently outperform their benchmarks than you do in the large cap space.
Right. But when you talk bottom up, you also have to look, other than, of course, tactical plays, you also have to be a little bit more thematic. So what are the themes within U.S. small caps that you're bullish on right now?
So again, the way we approach it is while we may look for themes within the pockets where we invest, we are not necessarily overweighting certain themes from the top down. So a lot of the themes I'm talking about that could drive outperformance of small caps, we're not necessarily trying to capitalize that inside of the small cap portfolio. But if we just look at technology, for example, because we're talking pretty extensively about that, right? AI obviously is a major theme. The AI infrastructure plays continue to be a major theme, and we have exposure to that. But also cloud computing, the foundational resources that support that growth of those two themes, automation. These are all themes that we look for in the first stage of our idea generation. But from there, it really becomes a fundamental process. What's the most attractive bottom-up story versus the one next to it? And we do that within each and every sector on our investment team.
Okay, great. And hope you have a great India visit, Vincent. Thank you so much for your time today. Good speaking with you.
Good speaking with you also. Thanks for having me.
Thanks.